So important definitions. So we're going to talk about anchor investor. Okay. Okay. So these are all basically. Okay. First we talk about a retail investor. Okay. Just read this. Retail investor means an individual investor who applies for bids for specified securities for a value not more than 2 lakhs. Okay, that means he is going to bid in a book building process. Okay, or he applies for shares if it is a fixed price. Retail individual shareholder means a shareholder who applies for or bids for a specified securities for a value not more than 2 lakhs. Okay, so either a individual investor, okay, or a individual shareholder. Okay, suppose he is already an existing shareholder, so maximum he can apply for 2 lakhs. Anchor investor, a qualified institutional buyer who makes an application for a value of at least 10 crores rupees in public issue through book building process. So he has to participate through book building process and he has to apply for at least 10 crores. So somebody is willing to give 10 crores to the company at the time of the inception of the company before the IPO opens. So he has to give the money. So we'll talk about that. So he is called an anchor investor. Okay. So we are going to talk about when you do your case study and all, so we'll find you do your IPO analysis, you'll find there are a lot of anchor investors who chip in and we talk about anchor investors more in detail. Anchor investor, also referred as cornerstone investor in some global market, are the institutional investors who are allotted shares a day before the IPO opens. Like, many big investors, like, we used to have Rakesh Jhunjhunwala, who was a very big trader. He used to be an anchor investor for many companies, okay? And of course, we have like Ramesh Dhamani in India, so many people who have a lot of money, so they put, money into new companies. So these are, anchor investors. So the shares are allotted them before the IPO is opened. So that means they have to give the money before the IPO opens. Big names in the anchor investors instill confidence in the retail investors. Retail investors tend to take cues from the anchor book. So you just look at the anchor book, who are the people who have given money, okay? So you know that, there are a lot of big investors who have put in money. So you will have confidence in applying for shares of that company. Qualified institutional buyers. So this is a very important definition. And qualified institutional buyers are those institutional investors who are generally perceived to possess expertise and financial muscle to evaluate and invest in capital markets. Okay, so these are big corporations, big companies in India who can read through, understand, and know that whether the share prices are right, the price band which has been fixed by the.
So the class muted for everyone. Cannot hear.
Achha, you. Okay, can you hear now?
So I think the screen has to be shared.
Huh?
The screen has to be shared for them.
Achha, screen, okay. Okay, so I've shared the screen. Now it should be visible and audible to all. If there is any issue, please let me know. Okay, so we're talking about. So we're talking about qualified institutional buyers. Okay, so these are basically big companies. Okay, who can read through the prospectus and understand the company. So they have both money as well as mindset to understand the issue. So who are the people? They are mutual funds. Okay, all the mutual fund company, asset management companies, they are the companies who are considered as one of the qualified institutional buyer. It can be venture capital fund. Okay, venture capitalist, then alternate investment fund. Okay, big investors like alternate investor fund, the ticket size is, for example, I don't know exact, but suppose it is 1 crore rupee. So anybody who is having a crore rupee, he can put money into these funds. So it is only meant for people who are HNIs. Okay, so that they are little bit riskier in nature, those investments. But if you can afford to invest 1 crore, then only you are, you can apply for into this fund. So they are like mutual funds, like we have studied mutual fund, but this is a different category where the SEBI regulations, there are separate regulations of the SEBI, how the big investors can put money, and the minimum ticket size has been prescribed by SEBI. Okay, like a new company, absolutely nobody knows it. Okay, like Baiju when it came, so people could have invested, at least minimum size was, ticket size was 1 crore, and there are many startups who come. Okay, so where they raise money before the company is listed. Okay, they start their business. So alternate funds, kind of they collect money, both venture capital fund also as well as alternate investment funds. Then the foreign venture capital investors, foreign portfolio investors, FPIs, anybody who wants to invest from abroad, money which is coming through FII route, foreign institutional investors. So it's called foreign portfolio investors. So then there is a specialized companies who do this job. So they are classified as QIBs. Okay. Public financial institutions in India, scheduled commercial bank, all the banks in India. Okay. Then multilateral and bilateral development financial institutions like World Bank, or there are many bodies which are called multilateral and bilateral development banks. So they can if they are interested in putting money into a IPO as a QIB, so they should be registered with SEBI. State industrial development corporations, insurance companies, they have a lot of money because people keep taking insurance, so they can also put money into the company. Provident fund with a minimum corpus of 25 crores. So normally, normally the international provident fund trust, people sitting in America, so all the money comes from various companies and they put into a kind of a provident fund where that money goes into the equity market. Okay, in India it is allowed, but not so much. Okay, so all the provident fund remains with in form of fixed deposit or government bonds, but only few amount can be put into equity markets. But the provident fund, the minimum corpus 25 crores, where big people, big companies like Microsoft or Apple, so they have their employees. Okay, and they contribute for their retirement benefit to a trust.
Like a pension fund.
It's a pension fund. Yeah. So now there will be a pension fund here. Okay, so pension fund and provident fund. So
what's the difference between provident and pension? Like
provident fund is basically, a pension fund is, of course, as you said, retirement, where you get a pension. And provident fund is that money is given back to you after you have completed your retirement, okay, in a lump sum. Okay.
Sort of like what LIC does.
Yeah. So here this money, actually what happens when you work in a company, then, the employer and employee both contribute some money in a fund. Okay. And maybe 10% each, and that money goes to a provident fund. And after you have completed, say, for example, at least 5 years, then you are entitled to take out the money. Okay. Like suppose you shift from one company to another, then the provident fund account will also shift from one company to another. Either that, that fund is maintained by Government of India through a Commissioner of Provident Fund, or it is, managed by the company through a separate trust. Okay. Where there, there is a Reliance Trust, Provident Fund Trust. There is a Aditya Birla, Provident Fund Trust. So when I was working, so sometime the money was going to, Provident Fund Commissioner, where there was no trust. And once I moved to another company like Reliance, there's a trust. So all the money from the government account came to my trust there. So I can see that, how much money, is getting built up in that account, so that when I retire ultimately, I'll get that money. But after 5 years, if you don't leave the job and don't work anywhere, you can withdraw your money also. Okay. And there is some portion which is converted into a pension, just 5% of the total amount. So that's called EPF and FPF. Okay, two portions of the provident fund.
So
Okay.
then in a single word, can we say, like, for proper understanding, it is sort of like a 104K system, what they follow in years.
Huh?
Like there is a system called 104K, where people start investing amount, then at the end of, once they retire, they get that back. It's sort of like the same system.
Absolutely. So like, we have provident fund, we have a superannuation fund also, where, which is actually like a pension fund in private companies. Okay. Then the government is going to give a pension. Superannuation fund, at least like, for example, I was working in company, 15% of my salary was contributed by the company directly into a superannuation fund. So at the time when I retire, so I'm getting some kind of a pension from all the companies which I retired. So that is through superannuation fund. So where, I was allowed to, get 1/3 of the amount was commuted. So I got the lump sum money. 2/3 was put in a pension, and that pension I'm getting from them. Okay. Provident fund, generally you get your money, whole money back. Okay. 99% of the money is returned back to you along with interest. Okay. So then we have the public financial institutions. Okay. Then we have the scheduled commercial banks, which I already covered. So these are basically all the QIBs. Okay. So they are basically the people who have a lot of money with them, either coming through some participation by the employees or like pension fund or this thing. Okay. So these bodies are called QIBs. Then we have qualified institutional placement. Okay, we talk about another thing. So we are just picking up something. Okay, like QIP, where the companies can raise money instead of going for an IPO or FPO or something like that. So the company can raise the money. Particularly, it's an alternative to FPO. Subsequently, when the company wants to raise more money, so instead of going for a FPO, they can raise the money from the select few. Okay, the QIP allows an Indian listed company. So it has to be a listed company. So that means instead of going for an FPO, the company has already gone for an IPO, company has already been listed. Now the company wants to raise further money. So there are various choices, either the rights issue, okay, which is mandatory unless the shareholders don't decide to give the money. Then the company can go for an FPO or can go for a QIP. Instead of asking again public to give the money and follow all the formalities and a long process, they can say, okay, we'll pick and choose the people who are going to put money in the company, and it's called QIP. So Anjana, can you read it? Padhi?
QIP allows an Indian listed company to raise capital from the listing market without the need to submit any pre-issue filings to market regulators.
So here basically you avoid all that formality, so that you don't have to file offer document to the SEBI, and you can raise the money directly. Okay. Just read again. Next.
QIP means issue of eligible securities by a listed issuer to qualified institutional buyers on a private placement basis. Includes an offer for sale of specific securities by the promoters and or promoters group on a private placement basis.
Okay. So means issue of eligible securities by a listed issuer to a qualified institutional buyers or on a private placement basis. Okay. This is called qualified institutional placement. Okay. So this means an issue of eligible securities. Okay, like the shares, new shares or debentures by a listed issuer. So the company has to be listed. Okay, already. Okay, not in IPO cannot be done through a QIP route. Okay, qualified institutional buyers. So that means the money is going to be raised from QIBs. Okay, here, not from the selected few, but QIBs. Only QIBs or 13 institutions, the money can be raised on a private placement basis. Okay, includes an offer for sale of specified securities by promoters or promoter group on a private placement basis. So that means here the promoters can also offer their shares to the QIBs directly. Okay, that means already there is a promoter, he can offer his own shares to the QIBs. Is that okay? Fine. Then we have application supported by block amount. So which is I have already discussed. Here the money the amount is blocked in your account when you apply, and the block is released if the shares are not allotted to you. Otherwise the block will be released and the money will go to the company account. Okay. Then IPO lead managers. So this is very important. This is merchant bankers. Okay. The course is merchant banking. So these are the main important people who help the company to raise the money. The lead manager, okay, or the merchant banker is a SEBI registered financial institution. So that means the merchant bankers need to be registered with SEBI. Okay. So they are also called lead managers. Okay, as well as merchant bankers. They play the most critical role in the IPO process. The book running lead managers. So they are also called book running lead manager. Okay, they can be called as merchant bankers, lead managers, or book running lead manager. Work closely with the company from the day one until the IPO shares get listed at the stock exchange. So they provide end-to-end service. Okay, drafting the prospectus, valuing the company, all kinds of stuff they do, deciding about what should be the price band. Okay, so IPO lead managers are also known as book running lead managers. Okay, so they're called book running lead manager, or in capital BRLM. Okay, fine. So these are the one name for all merchant bankers or lead managers or BRLM. Okay. Then the IPO lead managers are SEBI registered, independent financial institutions appointed by companies to help them with raising funds through IPO and getting listed at stock exchange. So their job is to get the shares listed on the stock exchange, okay, help the company throughout the process, okay, see that all the SEBI regulations are adhered to, okay, decide about the company's price at which the company is going to issue the share price, do a valuation of the company, okay, they provide end to end. So they are also called this the same thing. The lead managers manages the IPO process end to end. Some of their responsibilities include initiating the IPO processing, creating a DRHP and RHP. DRHP is basically draft red herring prospectus or red herring prospectus. Before the prospectus is issued, it's called the offer document. Okay. Now, the offer document can be called as red herring prospectus when the share price is not mentioned in the prospectus. Only a price band is given. And company has not decided how many shares, because if the price is not there, then the exact number of shares cannot be also told in the offer document. It will depend upon at what price it is going to get ultimately, decided which price it is. So depending on the maximum bid or where the 100% of money is collected, based on certain mechanism, the price of the IPO is decided. Once the price is decided, then we can decide about how many shares can be given. Okay, fine. So the draft red herring prospectus will be missing two things. One will be the price, the final price, and second will be the number of shares which they are going to offer. So till this process is complete, it's called draft red herring prospectus. Then after the IPO, it's called prospectus. After the IPO has been done, the name of this document is changed to prospectus. And then it is filed with the registrar, the final document. Okay. So it is like this: offer document, red herring prospectus, and the prospectus. Fine, that's a journey. Offer document, then the SEBI approves it, public also gives the comment, and all the comments and all the formalities of SEBI are taken care. If SEBI advises certain changes to it, if they are made, everything, they approve, then the company goes for an IPO. And after the IPO they have gone, they will mention the price band if the company is going for a book building, and then secondly, they will issue a draft red herring prospectus. Once the money is collected, everything comes and the issue is final, merchant bankers clear it, then it's called prospectus. Then the prospectus, final prospectus is filed with the registrar of companies as a record document. Okay. In case of any subsequent things, after years it is there with the registrar as a final document of the company, that company has raised the money and this is the final document. Okay. Then who are the lead managers in India? Indian, Yes Bank, ICICI Securities, Kotak, Mahindra Capital, Axis Bank, Tata Capital Markets, Reliance Securities, Bajaj Capital. So these are some of the few merchant bankers in India. And then we have, like ICICI Bank. Then we have, like this is international lead managers like FedEx Securities, Goldman Sachs, DSP Merrill Lynch, Deutsche Equities, then Morgan Stanley, Citigroup, Barclays Securities, Barclays Bank, and Deutsche Bank. So these are some of the international merchant bankers. Okay, fine. Then we talked about red herring prospectus, okay, which I have already discussed. So it is a red herring is a preliminary prospectus filed by a company with SEBI, usually in connection with the company's initial public offering. Okay, when a company wants to raise an IPO, they have to file a DHRP. A red herring prospectus contains most of the information pertaining to the company's operations and prospects, but does not include key details of the securities issue, such as its price and the number of shares offered, because that will be missing because the company has still not finalized the price. Okay, only after the book building process is done and based on the the outcome of the book building process, we'll come to know what will be the final price and what will be the total shares which the company is going to. Then we talk about promoters. Okay, generally any person who plays a major part in forming a company or establishing its business, usually prospective owners or directors of the company as regarded as promoters, the people who started the company, okay, with their own capital or their mind, whatever, and they are managing the company. They bring the business idea into the existence and sets the vision and growth targets for the company. Is that okay? They are the promoters. Promoter means people who are started the business. So just read this. Who has been identified as promoters by the company in its offer document or annual returns. So company will say that these are our promoters, okay, in their prospectus. Fine. So those are people who are promoter. Who has a direct or indirect control over the affairs of the company, whether as a shareholder, director, or otherwise. So they can be either shareholders of the company, main shareholders, or they are directors and the shareholders together, or otherwise, in accordance with whose advice, the direction, or instruction the board of directors of the company is accustomed to act. So they are the main people who do the business for the company. Okay, they run the board. Then promoter shall include a person who has been named as a in a draft of a document, okay, who has a control over the affairs of the issuer directly or indirectly, whether as a shareholder or otherwise. So I think this is a repetition in accordance with those advice, direction, sections of the board of the directors. Just read this, okay, it's the same thing again written in a different this thing. So then we have a green shoe option. Sometimes, the company supports the price. Once the IPO is done, okay, like when the idea IPO came, the share price was 70 rupees, 75 rupees. 10 rupees share was 75 rupees. So it opened in the market and it started falling. Okay, immediately it fell down to, say, I'm saying 60 rupees. I don't know whether it fell, but I'm just remembering it fell down to 60. So there is a green shoe option. That means some extra shares, the merchant bankers, they are going to play as a market maker. They are going to buy shares in the market to prop up the shares back to 75. So they won't allow the share to fall below the IPO price. Okay, so that any person who has applied for the share, he can exit from the company if he feels and he gets terrified because the share price has fallen at 60. So he lost 15 rupees in a matter of just half a day. So then the merchant bankers, they prop up the share and the share goes again back to the IPO level and people can exit. Okay, so that may be the objective of green shoe option. So the company will say that we have a green shoe option in their prospectus. So it will make sure that the prospective shareholders, they know that they can always exit if the price falls immediately on the day of listing. Okay, जिस दिन list हुआ अगर उस दिन गिरना शुरू हो गया, so you have a chance to exit, thinking that you have made a mistake. So you can always exit your money because it's a company backed kind of a thing, that they are backing the shares and putting the price back to the level at which they have issued to the public. Is it clear? So green shoe option is an option exercised by the underwriter to buy back a certain number of company shares at a fixed price to shore up the share price without risking any of its own capital. So without risking own capital, because that has been funded by the company. So we'll talk about that in detail. The underwriter is able to do so because at the time of an IPO, the company issues an additional 15% shares to the underwriter solely for the purpose of risk management in case the share price falls below the offer price listing. So the company is going to give him 15% extra share कि भैया इसको use कर सकते हो आप. If the price goes down, you can use it for either selling or buying, whatever, so that the share price goes up. So then we have the book building process. We are going to do little detailing about that, but little bit I have covered here. So this is a book building. So book building is a process that helps the companies discover the price of their security when the shares are being offered for sale in an IPO with the help of investment bankers. So book building, the merchant bankers play an important role in helping the company to raise the money through book building. Now the company can always issue shares at a fixed price or a book building. But generally the companies which are loss-making companies, okay, they have not made any past profits. They can raise money only through book building process. We are going to cover that in our slides in coming there. So there the book building is mandatory. Okay. Major stock exchanges and regulators recommend it because it is the most efficient mechanism to price securities in the market. Even if the company is a profit-making company, they can still go for a book building and it will help the company to discover what should be the right price for the company. Okay. So IPO, which we have already covered, so I'm just skipping that. Rights issue, I'm just going back to the slide where we left, okay, and cover a little bit more. Okay. Now, so we have covered the major definitions, okay? Now we come, and we have not covered, other like, the QIBs we have covered, retail investors we have covered, anchor investors we have covered. It's a category of investors we're talking about, okay? And HNIs is remaining a little bit. Initial public offer, the applicability of, this ICR is applicable to whom? To the IPO. Rights issue, okay? So if a company is coming with a right issue and if it is more than 50 crores, then they have to follow the ICDR regulations, okay? A FPO, a preferential issue by a listed issuer, a qualified institutional placement. So now there are these kinds of this thing, okay? First, it is applicable to an IPO. Second, it is applicable to a right issue, which has been offered to the existing shareholders. FPO, that means subsequently you are raising more money. Then a preferential issue by a listing. Preferential offering shares to only a selected few. Here, a qualified institutional placement, that means you're offering shares to only QIBs, okay? So there are two categories. One is to the people who you want to give, okay? Fine. The strategic investors, generally some companies, they bring some people on board, okay, that these people are going to help them to manage the company, or they have good money, so they can, place directly with those people, or company can go to QIBs directly, okay? And then it is applicable to IDR. Now there are ADRs and GDRs. Have you read them in your life? ADR, GDR. पढ़ा कभी? तो पढ़ा क्या है आपने अभी तक? ADR, GDR. Finance है ना आपका? How many students are from finance? 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 So ADR, GDR are very common things, okay? Like Reliance shares in India, they're listed, okay? I'm just going to be very concise, okay? I'll not go into detail. But in that conciseness, you will know what is an ADR. So ADR is like this. I will be here because these people can listen. So what is ADR? These are American Depository Receipts or Global Depository Receipts. So you can always Google and find out. And Ananya will Google, and then she's going to share it on a WhatsApp group. What are ADRs and GDRs? Okay, people can go through that. So like I just in a nutshell, if Reliance wants to, Reliance shares are listed on the stock exchange. Please focus here. Reliance shares, if you want to buy, you can go and buy it in the stock exchange. Okay, all the money has been collected in Reliance in India. If Reliance needs money abroad, suppose in America or Europe, so they can't issue shares directly to the American citizens. Okay, so what they'll do, they will, and you can't, issue your shares in America like that. So you have to comply with a lot of regulations, hundreds of regulations are there. So there is a very shortcut mechanism to get your shares listed in America, and that is called ADR or GDR. Okay, fine. So what the company will do, Reliance will pick up, some shares, say, yeah. हाँ? क्या हो गया? कोई ज्वाइन करना चाहता है? नीरज नीरदी, अच्छा, उसको टाइम मिल गया? Okay. Okay. ठीक है, I think she is joined.
Yes, sir. Thank you.
So applicability of the regulations. So we are talking about ICDR, okay? Fine. So these regulations are applicable to IPO, to rights issue, to, sorry. So this was here basically, okay? Fine, up to this we have done. So we just go back and say applicable initial public offer is, is for IDRs. So we're talking about IDRs, okay? So first, before we understand IDR, we were understanding what are ADRs and GDRs. So what Reliance will do is, Reliance wants to issue shares in NASDAQ or New York Stock Exchange. It can, go into any exchange and offer their shares there. They are offered in form of ADRs. What Reliance will do, they will, pick a bundle of shares, of their own shares. Say a bundle of either 1, 2, 3, 4, 5. It can be either 3 shares, 4 shares, 5 shares of Reliance, whatever they want. Okay. Suppose each share of Reliance is 2,500 today. Suppose they make a bundle of 2 or bundle of 4. So it will be, priced at 10,000 bucks. and they want to collect this 10,000 rupees in America in dollar terms. So they will make a bundle of 4 shares and deposit with a custodian in America, a banker, big bank there, as a custodian. So the banker will keep the shares with them, and they will offer a receipt that we now have, 4 shares of Reliance. Similarly, they'll make bundles of that. Okay, bundles in multiples of say 100,000, lakh, whatever. Okay, those for bundles, for each bundle of 4, they'll issue one receipt. It will be called American deposit receipt. Then those ADRs will be offered to the American citizens so that they can buy it. So 10,000 rupees share converted into dollars. Suppose the dollar is, for example, 100 rupees. So that means each share will be $100. Each ADR will be $100. If assuming that dollar is $100, so each share will now become $100 at the time when it's listed on the stock exchange in New York Stock Exchange. Thereafter, it will trade of its own. Okay, it will go up or down depending upon what is happening to Reliance, both in India as well as abroad. Okay, so these are called ADRs. And similarly, it's GDR if it is issued any place other than America. Same mechanism. Now, similarly, a company who is abroad, they can come to India, they want to issue shares, and they are called IDRs. Okay, so any company who wants to raise money in India through shares, equity shares, they can do so through the process of IDR. So far, about I think 15 years back, this law was formed. No company has in India come to India to raise money through IDR. Only Standard Chartered Bank. So there are IDRs of Standard Chartered Bank which are still listed on the stock exchange. Yeah.
So should the companies in other countries be listed in their own exchange so that they can?
Yeah, definitely. It should be. Normally, that should be the procedure. That's a good question. Okay. So you can always ask this question to ChatGPT and find out what the answer is. But according to me, it should be listed. Okay. Then only, that can be, the ADRs and GDRs can be, or IDRs can be issued. Right issue. So these are all ideas basically, right issue of IDR or IPO or FPO. So there are hardly any companies in India, only one company which has come to India to raise the money through IDR, which is Standard Chartered Bank. So in IPO by a small and medium enterprise. So again, the regulations are applicable to those companies also. If a small and medium company, they want to raise money for the first time, the law is applicable. A listing on innovators growth platform, that means any startup, they want to raise money, so they have to follow these regulations. A bonus issue by the listed issuer. Suppose the company wants to issue bonus. Okay, a company can issue bonus without charging any money to this thing. So only they can capitalize their reserves and issue shares to the public. So we talk about a little bit more later on what is the bonus. Now we come to the main one. Okay, so for some time we are going to talk about that. So 1 o'clock. So our class is up to 2 o'clock, isn't it? So we'll leave it at 1:30. Okay, fine. Or half an hour last class rakhenge after a little break which I give you now after some time. Okay, another 10 minutes we'll continue and small break, and then the last half an hour we'll cover. IPO on main board, because now we have entered into a most important phase, that an IPO on main board, the main stock exchange. Okay. So what is the main board? Just read, anyone who has a little bit louder voice, आप पढ़ सकते हैं?
Main board means a recognized stock exchange having nationwide trading terminals other than SME exchange. When a privately held company sells shares to the public for the first time and becomes listed on stock exchanges, it is known as a main board IPO unit. These big corporations have a post-issue paid-up capital requirement of at least 10 crores.
So all the companies who are raising capital more than 10 crores can issue their IPO through a main board, which is a main stock exchange. Okay, and then there is another platform which is SME platform. This is meant only for small, and medium companies. Okay, so it's and then we have the SME exchange. Read it.
SME exchange means a trading platform of a recognized stock exchange having nationwide trading terminals permitted by the board to list a specified securities, issued in accordance with Chapter
9.
9 and includes a stock exchange granted recognition for this purpose but does not include the main board.
So basically, this is only for small and medium enterprises. If they want to issue an IPO, and some benefits are given so that they can easily list. They will not compete with the main IPO shares, main stock exchange. Yeah.
An SME exchange is a stock exchange dedicated for trading the shares securities of SMEs who otherwise find it difficult to to get listed on the main board. At present, there are only two SME exchanges in India, the BSE SME platform and Emerge platform.
So there are two platforms on which small companies can issue. Okay. Okay. So this we go back to our this thing. Yeah. Then we talk about now. These are the regulation numbers. Okay. Fine. So what you can do is you can just go to this site and download the ICDR. Of course, I forgot to upload it on a WhatsApp group or a Google this thing Blackboard. So you can just download that. Okay. Fine. It is available. Okay. So you can do it at home, no problem, or do it now, whatever you want, and then we will discuss that later. Okay, what I'll do is that I'm going to take this. Okay, I have got downloaded it, so I'm just going. So regulation number 4 to 55 is concerning an IPO. Regulation number 101 to 131 concerning a FPO. Fine. So it's a very big document. Of course, I don't expect that you people to go through this document and understand this document and remember all the regulation numbers and all. No need. Okay. Fine. And if at all you have to refer it, because it's going to be take home paper, you can always open this ICR and go through if you want. Okay. If you won't have, I don't think you will have ever require to go through that document. Okay. But for your knowledge, if you want, you can run through this document. Okay. Fine. So we'll go take. I mean, I'll take you through this document maybe next time or maybe after some time today. Next after the break. So entities not eligible to make an initial public offer. First of all, these are the companies who are not allowed to raise money in India through an IPO. First, an issuer shall not be eligible to make an initial public offer if the issuer or any of the promoters or promoter groups or directors or the selling shareholders are debarred from accessing the capital markets by board. Okay. Like for example, Vijay Mallya was debarred. Fine. Or some people have been debarred. They can't go. Like Anil Ambani has been debarred to raise capital. Okay. So they can't raise an IPO for a new company for a certain number of period. Okay. Time. And if the issuer or any of its promoters, promoter group or directors or selling shareholders are debarred from accessing the capital market by the board. Either it is promoters or directors or you want to offer your shares for sale. No, not allowed. Okay. For the people who have been debarred from by the board. If any of the promoters or directors or issuer is a promoter or a director of any other company which is debarred from accessing the capital markets. If any of the promoters or directors of the issuer is a promoter. Now, if suppose you are a promoter of another company and of that company you have been debarred, so even the main company you can't issue. If you are associated with the company and that company has been debarred or the directors of the company has been debarred or the promoters of that company has been debarred. Okay. Now, you will not be able to allow to issue shares of their own. Okay. So, neither you nor your associate companies, they have been debarred, so you can't issue. Okay. Then, if the issuer or any of its promoters or directors are willful defaulters or fraudulent borrowers, like Vijay Mallya again, he has been a willful defaulter. Okay. He has defaulted in loans. So, then that means either he will get covered under number 1 or here. Then this third one is also here. If any of the promoters is a fugitive economic offender. Now, there is a law called economic offender law. So, if you have been declared as a fugitive economic offender under the law, then you will not be allowed to raise capital from the one. So, these are the 5 entities who are not allowed to raise the capital. Okay. Then, last one. Issuers shall not be eligible to make a IPO if there are any outstanding convertible securities. That means if you have issued shares as convertible, that means you are going to convert them into shares at a later date. To start with, they were debentures, they are bonds, and after 1 year, they will become shares. Okay. So, if you have such kind of instruments, you are not allowed to go for an IPO unless you have converted all the shares into shares, in debentures into shares. Okay. The conversion has already taken place. If there are any outstanding convertible securities or any other rights which would entitle any person with any option to receive equity shares. Like for example, only exception is ESOPs. If you have given shares to the employees, rights to the employees that you will get shares, except that any right given to anyone that he can buy shares of the company in a subsequent time, if you have those things existing, then the company cannot raise cannot go to for an IPO unless all the rights have been either cancelled or the shares have been fully converted, okay, into the shares. Then only the company can raise the money through an IPO. Is that clear?
So I'm not understanding why this exists.
It is. This is a good question. That why it is. Now, if suppose there are people who have been sitting on rights that they can acquire shares. So the new shareholders who are coming, okay, they don't know. You know, there is some uncertainty there in the company. You know, some people are going to get shares, some rights have been given to someone, whether they are going to exercise or not. At least that should be a clarity should be brought, so that new people who come, they come with a clean slate. Okay, so that there is no ambiguity. If suppose you have a right to the company, you can pick up say 1 lakh shares of the company, but you don't exercise right. It's just a right. So your right should have been exhausted before a company can come in an IPO. You can't keep something on hang. Okay, fine. So only ESOPs are considered to be allowed. Employees' rights will not get affected. Issuer shall be eligible to make a public offer only. Now, these are very important. We'll cover this. This is the most important part. An issuer shall be eligible to make an initial public offer only if it has, now there are certain financial criteria, okay, they have to meet. If they don't meet this financial criteria, then the companies are not allowed to come with an IPO. Okay, fine. Except there is I told you that even loss-making companies can come and issue shares. Okay, even if they are not meeting, but there is a separate window for that. So it has a net tangible asset of at least 3 crore rupees. They should have net tangible assets. That means plant and equipment, machine, land, building. So these are tangible assets. Non-tangible assets like copyrights, patents. So ignore that. So only tangible assets. Net tangible means all liability. The company has taken a loan, then that should be excluded. Okay. So it is like this. Not net tangible as total assets minus intangible assets minus total liabilities to become tangible. So plant, land, vehicle, machine, equipment, stock, furniture. Okay. So if it has 10 net, just read it.
It has net tangible assets of at least 3 crore rupees calculated on a restated and consolidated basis in each of the preceding 3 full years of 12 months each, of which not more than 50% are held in monetary assets.
Now, this is a clause which says that the companies first of all should have at least 3 crore rupees annual, the last 3 years. Now, on a consolidated basis, like suppose you have a subsidiary, so altogether put together, it should be, how much? 3 crores, okay? And maybe sometime the company restates its balance sheet and, again regroup certain assets, categories. So you can do that after restating and consolidating. So the total asset value should be 3 crores, okay, on an average. Not an average for the preceding 3 full years, not average, but preceding 3 full years. And which not more than 50% should not be monetary assets. It's not like, suppose if I'm not having 3 crore rupees of asset in a particular year, last year, I will, borrow money, okay, from someone. Or, as a promoter, I'm going to put 3 crores in my bank account. So I have all the net tangible assets. So if I'm putting money into my bank account, that's called monetary asset. Okay. So excluding the monetary asset, so less than 50% should be monetary asset. उसमें cash bank balance जो होना चाहिए वो 3 करोड़ 50% से कम होना चाहिए. So I'll just show you an example here. So before we understand the figures, so one more. Provided that if more than 50% of the net intangible assets or net tangible assets are held in monetary assets, the issuer has utilized or made firm commitments to utilize such excess monetary assets in business or project. That means if you have some money lying in bank account, okay, then the company should actually utilize it or make a plan. Okay, I'm going to buy a building very soon, 2 months from now. I've issued a purchase order for buying equipment. So that document should be shown to SEBI that all the money which the company was having, that has been tied up, and there is some future plans to come out of that money. Okay, it should not lie in a liquid form. आपने सिर्फ पैसा बढ़ा दिया to just say that I am now meeting the criteria for an IPO. No, you can't do that. Okay, fine. So let's talk about what are the monetary assets. It can be, a bank deposits, receivables. You can show that I have to receive some 2 crore rupees from someone. So you are having that as an asset. That will be counted for net tangible asset. Okay, but that is a monetary asset. Okay, so it can't be more than 50%, should not be more than monetary assets. Okay, let's talk about here. So what are the monetary assets? Example, bank deposits, trade receivables, cash, short-term investment. Altogether, in this company from last 3 years, you have 4.5 crores, 6.5 crores and 7.5 crores monetary assets. Okay. Now, if I take all these assets here now and put them here, 4.5, 5.5, 6, 7.5 like this. Now, if I calculate my net tangible assets, I have fixed asset, intangible assets, monetary assets and total assets. Then intangible assets is basically minus the intangible assets, Liabilities are, then we have the net tangible assets. Monetary assets are 28%, 27%, 31%. It is meeting the criteria because not more than 50% are monetary assets. Oh, okay. So I'll just show you an Excel sheet, okay, which I have shared also in the morning. So you can just open to understand this more clearly. So net tangible assets, okay, fine. So this is the chart. Can you see? It's there in your WhatsApp group. So these are monetary assets, okay, and this is the total net tangible assets. So you can change any number, okay. For example, suppose you have put here 8 crore is bank deposit. Suppose you make it 58. What will happen? The net total asset will become 64. So this is not allowed. Okay, and because your 64% of the assets are in monetary nature, so monetary assets have jumped up to 64%. It's not allowed. Okay, fine. Even the previous figure was allowed because it was all below 50. So this is this thing. Okay. Suppose if I make a change here and make it to 40 crores, your fixed assets are 40 crores. What will happen? Still okay. Suppose I say 20 crores. Now, this is not allowed because here your monetary assets are 72% of the total assets. Okay, fine. So you can just go through this Excel sheet to understand this. I'll just repeat this. I was a little faster when I was explaining. So just read this in your mind. Okay. Eligibility requirement for an IPO. So company must have certain net tangible assets. Okay. For last 3 years, हर साल में 3-3 करोड़ होने चाहिए, ओके, और 50% से ज़्यादा मॉनेटरी एसेट नहीं होने चाहिए. That means your bank balance and some liquid assets should not cross more than 50%. Okay, so net tangible asset is basically your total. You minus the tangible assets, copyright, patents, everything. You minus it off, minus of all your liabilities. Okay, so that means, and then after that it becomes net tangible, and your monetary assets which are in form of receivables or cash and bank balance or some investments, so that should not be more than 50% of your total net tangible assets. Okay, so here if we look at, these are net tangible assets, sorry, these are monetary assets, all money assets like bank balance, trade receivables and everything, cash. So now if you plug this figure here and calculate what is my percentage of monetary assets, so in every year it is meeting the criteria. They are not exceeding 50%. So this company is meeting the criteria, isn't it? Okay. Then provided further that the limit of 50% on monetary assets shall not be applicable in case of an IPO made entirely through offer for sale. If the company is coming in IPO and suppose it's coming only through offer for sale, okay, no fresh issue, then this regulation is not applicable. Okay, entirely. Like a company may come with that it's offering all the money, all the shares are already held by promoters. Now it's offering all the shares to the public through an IPO. So then this monetary asset clause will not be applicable, except in that case. Is that okay? You hold on. क्या बोल रहा है?
All the promoters are giving up their rights.
All the promoters?
When there's an offer fulfilled, all the promoters are giving up their rights.
हाँ.
If they want, they can buy a small amount of shares to just maintain their life.
They can just maintain some amount so that remain the control of the company. Okay. Suppose I am 100% shareholder of the company. I am a promoter. I can reduce it to 49%. I can become a 51% shareholder, still remain the promoter. 49% I can offer to the public through an IPO process, isn't it? If I am holding 100% shares, or myself and my son or my brothers, we hold 100% shares of the company. Okay, the company is good, profitable. So I come with an IPO where I offer 49% of my own shares to the public. So it's an offer for sale. In that case, monetary assets will not be, this clause will not be applicable. One more, there are 3 criteria. Let me finish this and then we'll have done the major part of it. It has an average operating profit. The company should be in profits. Operating profit, not net profit. Okay. It has an average operating profit of at least 15 crores calculated on restated and consolidated basis during the preceding 3 years, with operating profit in each of these preceding 3 years. So that means the company should be profitable, should have at least 15 crores of profit, and it should be profitable all throughout for this last 3 years. For example, like this. Here, This is the total sale of the company, revenue. This is the total cost of goods sold, gross profit, expenses, salaries, rent, depreciation, operating expenses, operating profit. So before paying interest, okay, or other things, or tax, this is called the operating profit. Before paying the taxes, before paying the interest on loans, the money which is calculated, the profit which is calculated is called the operating profit. So in all the years, the company is becoming profitable. Is it 22 crores, 10 crores, 12 crores, and average is 15. Okay. So companies average is 15, it's met the criteria. 15 crore की average तो होनी चाहिए और हर साल company का profit होना चाहिए. Okay. In the Excel sheet, I have given that number, so you can just play around and see. Okay. So I am not again taking you to the Excel sheet. Then the last criteria, the most important one, it has a net worth. First is what? First was the net tangible assets. More than how much? Huh? More than 3 crores, isn't it? Or profit 15 crore. Net tangible asset 3 crore, profit 15 crore. Last is net worth. The net worth should be at least 1 crores. Okay. The net worth is what? All your assets which you own minus your liabilities. Fine. Suppose I have total money lying in a bank account and building, everything I count it. Personal net worth. Suppose I own say 5 crores and I have to pay 1 crore to the loan to the bank. So my net worth is 4 crores. So generally when you go to a bank applying for loans, they ask for your net worth. So net worth is nothing but all the assets minus the liabilities. It has a net worth of at least 1 crore rupees in each of the preceding 3 full years. Okay. Of the 12 months calculated on restated and consolidated, it has a net worth of at least 1 crore rupees in each of the preceding 3 years. Okay. So it is basically assets minus liabilities. So if you look at this net worth, so you have fixed assets, total assets, current liabilities, borrowing, and net worth. So this is the net worth. Okay. So you take all the assets minus the borrowings, so you have the net worth. Is that okay? Is that okay? Okay, let me just finish another 5 minutes. I think we will be done most of it. Then we can have a small break and wind up and take the attendance and close that chapter. Okay, just couple of more slides to go. The important ones, I'm just covering that. I'll go up to this, okay, I'm just telling you. Up to this, okay. 1, 2, 3, 4. यहाँ तक था बस इतनी स्लाइड करनी है हमने कर लिया अभी देन वी एंड ऑफ द लेक्चर फॉर एवर ओके फाइन सो एलिजिबल रिगार्डिंग IPO नाउ द कंपनी कैन चेंज द नेम company can change its name okay fine so just read
if it has changed its name within the last 1 year at least 50% of the revenue calculated on a restated and consolidated basis for the preceding 1 year has been earned by it from the activity indicated by its new name.
Okay, like this, suppose the company was called earlier ABC Car Limited. Now the company has changed it to ABC Scooter Limited. So that means the company is now manufacturing only scooters, not the cars. So company business has changed almost with the name change. Okay, so if this was the turnover in last year, okay, so total turnover was 250 crore sale, 60% is coming from the new name. If this is there, then the company can go ahead with an IPO. So at least 50% they should meet from the new name. Okay, fine. It has changed its name within the last 1 year. At least 50% of the revenue calculated on restated and has been earned by it from the activity indicated by the new name. Is that okay? नए नाम से जो कंपनी का रेवेन्यू है मोर देन 50% होनी चाहिए तभी वो कर सकती है. द कंपनी हैज चेंज द नेम. देन एन इश्यूअर मेकिंग एन IPO शैल इंश्योर दैट इट हैज मेड एन एप्लीकेशन टू वन. हाँ, इसको जस्ट रीड दिस.
An issuer making an initial public offer shall ensure that it has made an application to one or more stock exchanges to seek an in-principle approval for listing of its specified securities on such stock exchanges and has chosen one of them as the designated stock exchange.
So it has made an application to one or more stock exchanges to seek in principle approval for listing of the specified securities on such stock exchanges and has chosen one of them as designated stock exchange. That means there are two stock exchanges in India, National Stock Exchange and Bombay Stock Exchange. So it has made arrangement for listing. They have got the principal approval that we are going to list at both the exchanges, or we are going to list at only Bombay Stock Exchange or a National Stock Exchange. Then we must get an approval from them. If we have got the approval from both of them, at least one should be considered as at designated stock exchange. Okay. One of them as designated stock exchange. So we can either say we are designated Bombay Stock Exchange or National Stock Exchange. So first of all, approval from the stock exchange and then making one exchange as a main stock exchange. Is that okay? Then
It has entered into an agreement with the depository for dematerialization of the specified securities already issued and proposed to be issued.
so nowadays all the shares has to be in demat form. It can't be in a physical form. Okay. Fine. So everything is demat. So they have made arrangement with the depository that all the shares will be in demat account. Okay.
All its specified securities held by the promoters are in dematerialized form prior to filing of the offer document.
Now, long back, I have still some shares of one company which is still in the physical form. I have not even lodged with the company for converting them into demat. So if promoters are having such case, they should first get themselves in demat account. Okay. Then only the company can go ahead with an IPO. So all the promoters' shares should be in a demat account. It can't be just in a paper format. सर्टिफिकेट फॉर्म में नहीं होना चाहिए था. पहले सर्टिफिकेट फॉर्म में इशू होता था. आई यूज्ड टू बाय शेयर्स अर्लियर. इट शुड बी इन सर्टिफिकेट फॉर्म of Tata Steel company. I used to have shares. Okay. Now all the shares have been now converted into demat account. They are on like electronic passbook is there. The shares are listed there. Okay. Shares are mentioned in the demat account. आगे.
All its existing party paid up equity shares have either been fully paid up or have been forfeited.
So if there are any partly paid up shares, okay, in the company, suppose company has issued shares before going for an IPO and they are yet to collect some money from the shareholders, the company cannot go with an IPO. First, collect the money, make whatever is the existing share capital of the company. If somebody has not paid, get it fully paid. If not, forfeit their shares. Okay. So it should be done before a company can issue shares. General conditions. Aage.
It has made firm arrangements of finance through verifiable means towards 75% of the stated means of finance for a specific project proposed to be funded from the issue proceeds, excluding the amount to be raised through the proposed public issue or through existing identifiable internal accruals.
Okay, very difficult to understand. Let's see. Here, example. Suppose there is a company which is going to for an IPO. So the total cost, they need 2,000 crores for the new project. Okay. They say how we are going to finance it. One, proposed public issue. That means we are going to pick up 1,000 crores from the public. Okay, that's an IPO. So they're saying that we are going to plan to invest 2,000 crores and how we are going to finance it. 1,000 crores from an IPO. Internal accruals, that means we have reserves and surpluses with us. Up to 200 crores will be met from our internal accruals from the profits earned in past. And loans, we are going to take loans. So if they mention loans, it can't be like that. They have to mention, they have to get a firm arrangement. They have to get a letter from the bank. That bank says, okay, we are going to lend you 75% of the money. It's at least 600 crores the bank should commit that we have gone through your application and we are ready to give you 600 crores as soon as your IPO is in place. So this is, it has made firm arrangements of finance through verifiable means towards 75% of the stated means of finance for a specified project proposed to be funded from the issue proceeds, excluding the amount to be raised through proposed public issue or through existing identifiable internal accruals. So excluding this, लेफ्ट इज 8. इसका 75% का आपके पास प्रूफ होना चाहिए कि आपने बैंक से लेटर ले लिया है और बैंक इज सेइंग दैट वी आर गोइंग टू गिव यू 70. आई मीन इफ द बैंक इज फाइनेंसिंग इट or if somebody else is financing, he should give a certificate, okay, that we are going to give this much of company to the money to the company. Is that okay? Now if you read the here, you will be able to follow it. Okay, so you can just read it at home, okay, to understand it fully. Okay, so ये हो गया. The amount of, now the company would say that, okay, we are going to spend some money. How we are going to spend our money? We are going to take 2,000 crores from, total project cost is 2,000 crores. So just read this.
The amount for general corporate purpose as mentioned in objects of the issue in that the draft offer document and the offer document shall not exceed 25% of the amount being raised by the issuer.
The amount of general corporate purpose as mentioned in the objects of the issue in the draft offer document and offer document shall not exceed 25% of this thing. Okay. Now, suppose this is the project cost. Through example, we can always understand. Suppose this is the cost, this is the money I am going to spend. The company is going to spend. So this is the object of the issue, IPO. Okay. So they say that plant and machinery, 1,000 crores, land 500 crores, general corporate purpose 500. So here they are not mentioning what is the meaning of general corporate purpose. भाई कंपनी के काम के लिए बाकी 500 crore. They can't keep it like that. Okay. So, and it is 25% here. Okay. So, only up to 25% is allowed. If it is more, then they'll say give the specific where you're going to put the money. Okay. And now, now the rule has changed further that they can always say investment purpose, इतने का plant, इतने का land, इतने का investment, इतने का general. So what they did was they were trying to make a jugglery कि इतना invest करेंगे, इतना general purpose करेंगे. तो इन दोनों को मिला के भी new amendment, general corporate purpose and unidentified investment should not be more than 35%. Okay. So that means the whole purpose is that while you are raising money, you have to mention clearly where you are going to put the money. It can't be in an ambiguous form. Okay. So you have to tell where you are going to put money. एटलीस्ट 35% हो सकता है कि इन्वेस्टमेंट करेंगे कहीं, कहाँ करेंगे अभी डिसाइड नहीं करा, और जनरल कॉर्पोरेट पर्पस के लिए जो कुछ स्पेंड करना है वो आप डाल सकते हैं. बाकी आपका 65% ऑफ मनी शुड बी क्लियरली स्टेटेड. इज दैट ओके? ओके. सो द लास्ट स्लाइड. ओके, वेरी इंपॉर्टेंट. आई थिंक एवरीबडी शुड बी देयर. एक गई है, एक ही क्या है? समबडी एल्स इज आउट. ओके, चलो जस्ट रीड दिस.
An issuer not
सो पहले ऊपर से.
Okay, eligibility requirements for an initial public offer, alternate eligibility. An issuer not satisfying the stipulated conditions shall be eligible to make an initial public offer only if the issue is made through the book building process and the issuer undertakes to allot at least 75% of the net offer to qualified institutional buyers and to refund the full subscription money if it fails to do so.
So that means if the company has not met all the financial criteria with regard to net worth, with regard to operating profit, with regard to net tangible assets, if the company is not meeting, company can still come with an IPO, but the money should be picked up from QIBs and it should be through the book building process, not a fixed price. Okay. So, issuer not satisfying the stipulated conditions shall be eligible to make initial public offer only if the issue is made through book building process. First, it should be done through book building, through by raising a price band and inviting offers from the investors. And the issuer undertakes to allot at least 75% of the net offer to the qualified institutional buyers. So, 75% minimum should be picked up from all the big companies in India, mutual funds, public financial institutions, and you know the pension funds and all those 13 people which I mentioned in the morning, and refund so if the money is not collected this way. Okay. If the company fails to do this, then the company has to return the money. Okay. So this completes the first paragraph. So next time I'm going to start from here. It's called alternate eligibility. Very important. Okay. So but there is this thing. There is this link. Okay. Just open this link बिफोर वी एंड. ये आपका जो प्रोजेक्ट है ना, आपका जो आपने करना है, आपको सारा मटेरियल यहाँ से मिल जाएगा. ग्रुप प्रोजेक्ट. ओके. सो जस्ट गो एंड पुट इट ऑन गूगल. सो इफ यू गो एंड फाइंड आउट, okay. So this is the National Stock Exchange site, okay, which tells you about, you know, the current issues which are in pipeline. So these are the current issues which are already in pipeline. Okay, like there are two companies, this Infrastructure Limited and Usha Financial Services, and you know one is SME and one is equity. So they are raising money by issuing equity. So this is an IPO. Okay, it could be mentioned here IPO or whatever. And then issue date starts, issue end date, status active. So currently they have been under the process. Okay, and these are the numbers of shares been offered, and these are the, you know, some more details, how many bids have been made, past issues, upcoming issues. Then you have IPO, OFS and other offers, mutual funds, GSECs or you know something. So there are 4-5 categories. So this is IPO and OFS, offer for sale. This is offers for sale. Okay, this is IPO which we have already done, and this is for the GSEC. So the company wants to, you know, if somebody wants to raise money through GSEC, that may be only for non-convertible bonds. Okay, okay. So past issues. Let's look at the past issues. Okay, you will find all the issues like Zomato or Paytm and everything. So this is basically, you know, giving you all the list. Okay, fine. So fine. So you can go as from the time when it started in India, so they have given everything, okay? All the details of all the companies, okay? So company name you can say for example, Zomato. So you will have Zomato. Equity shares, issue price was 76, symbol Zomato. So this was in 2021. The price band was between 72 to 76, okay? Date of listing when the share got listed, and you have all the details of Zomato here. You can either Google and find out all the details, or you will have all the details here, okay? Fine. So just a few that, so this was basically a company which was not profitable, okay? So, so almost like most of the money was coming from QIBs, okay? And number of times, so QIBs, total, oversubscription was, the oversubscription is given at the bottom, okay? So this got 21 times they got more than money which they required. जितना पैसा चाहिए था 21 गुना oversubscribe गया, okay? And each category had its own this thing, okay? The retail individual investors, these are the shares were given to them. So these are the shares they applied for. This was, allotted. So they had applied 4 times more than what they had offered, okay? Fine. Then the employees, so this many shares, they had actually so many employees had gone for, 65 lakh shares were applied for under employee quota, but ultimately they were allotted this much. So this was, 0.7 times or something like that, okay?
So this is only through NSE, right? This does not include the BSE.
BSE का अलग होगा.
So like because लोग BSE और NSE से करते हैं.
हाँ, generally NSE is a major stock exchange, and most of the companies are listed on National Stock Exchange as well as Bombay. And 99% of the companies are making NSE as the designated exchange. Your question is right, but here it is only all the NSE. Okay, so you can go and understand each. So next time I'm going to take you through the one full IPO process, okay? And we are going to understand the prospectus and everything, and understand all, we will drill down everything, okay? Fine. So that ends the lecture for the day.